Welcome to More Financial Talk. I'm Ryan Moore, and with me today is co-host Tony Shore. How you doing, Tony?
Oh, I am really excited to be here today. I always tell you I'm excited to be on the show with you, Ryan, and I thank you for having me on each week because I always learn something from you. But today, extra special. You have a huge guest for our listeners and viewers out there, and I am so excited about the show today. I've been thinking about it all day, looking forward to it. Gave me something to look forward to all week. Ryan, this is a huge get. I've had a great week, by the way. I know you've been busy. You're doing good. You've been traveling a little bit, meeting with clients. I think that's great. But we should jump right into it and introduce our special guest today.
Yeah, so we are super honored and excited to have with us a national best-selling author and one of the top tax planning authorities on tax advantage planning in our nation, David McKnight. How are you today, David?
I'm good. Thanks, guys, for having me. Looking forward to the chat.
Yeah, so David, you and I go back a ways. In fact, we first met back in 2019 when I was invited to attend a boot camp training that you hosted and conducted in Charlotte. So I can't believe it's already been 6 years, Dave.
Time does fly when you're dealing with COVID lockdowns and bull runs in the stock market of historic proportions, and Trump getting elected to a second term, all happening in those intervening years. So it's been a crazy 6 years, and time certainly flies when you're having fun.
Yeah, not much has happened at all in the last 6 years. It's a joke. Well, look, I just have to give you a lot of credit because what I learned from you and what I continue to learn has really been instrumental in my practice and in my business. And ultimately what that does is it helps my clients. And, I think our clients very much appreciate the knowledge I've been able to pass along as it relates to tax planning. It's really mind blowing to me. I hear this over and over that only about 25% of financial advisors do any type of tax planning as it relates to investments. What I can't wrap my head around is how everybody puts themselves out there as fiduciaries, and the biggest expense that we have in our lifetime is taxes, but yet 3/4 of the advisors don't even focus on that for folks. So I want to thank you for empowering me to be able to help my clients in a extremely valuable way, and I know my clients appreciate it as well. So Dave, I know you're a man on a mission. I've always known you to be a man on a mission. And maybe we can take a step back here and you can kind of give us an overview as to how you got on this mission and how you started the career path that you're on to be able to, help educate so many on, this type of focus as it relates to tax planning.
Sure. And again, thanks for having me on. I started in the industry back in 1997. And when I started, in the very year that Bill Clinton, in the very year that I started in this industry, Bill Clinton stood before Congress in the State of the Union, and he says, "I've got great news. The national deficit," which is not the national debt, it's just what they're spending relative to what the federal budget is relative to how much tax was coming in that year. He says, "I got great news. The federal deficit is simply zero." And he says, we've got budget surpluses as far as the eye can see. In fact, it's true. He did have budget surpluses as far as the eye could see. In fact, in 1997, the budget surpluses went all the way out to 2023. So things were pretty rosy. The national debt was only $5 trillion, and it's okay for countries to have some national debt. It's all about debt to GDP, and the debt to GDP was totally reasonable back then. But boy, it's been a wild 25, 30 years since then, huh, Ryan? I mean, we've gone from $5 trillion of debt and budget surpluses to now $2 trillion budget deficits per year for the next 10 years, $3 trillion per year in the years beyond. We're now closing in on $37 trillion of national debt. And you know what? Both political parties have been equal opportunity offenders. If you look at all that debt, about half of it came under Democratic presidential administrations, and the other half came under the Republicans. And so we're equal opportunity offenders here. And so the problem is, being able to pay for the interest to service all this debt is just not in the cards for our country. We're, like I said, we're picking up $2 trillion of debt every year for the next 10 years. Trump is about to extend his tax cuts, his signature tax legislation from his first term. He's about to extend that for another 8 years. We'll talk about the big, beautiful bill here, I'm sure, in a little bit. But that's going to add another $5 trillion, according to the Committee for a Responsible Federal Budget and Maya McGinnis, who've really done a great job of crunching the numbers. It's going to add another $5 trillion to the debt. So by the time 2034 rolls around, you have $57 trillion from just our profligate spending, and then another $5 trillion from the extension of these Trump tax cuts, though they're not really paid for. So we're looking at $62 trillion of national debt. We are fast approaching a point in our country when we won't be able to afford to pay for that. In fact, former Comptroller General of the federal government, David Walker, who I admire and who I follow closely, has said that tax rates have to double to keep our country solvent. The Penn Wharton University just recently did a study where they basically said that if we don't right our fiscal ship of state soon, that no combination of raising taxes or reducing spending will arrest the financial collapse of our nation. In fact, they specifically says that when we hit about 200% debt to GDP, they think that'll happen between 2040 and 2043, that the debt starts to snowball. We don't have enough revenue coming in to be able to pay the interest on all that debt, plus pay all of our other bills, and you just can't get on top of it. And that's when financial catastrophe really happens. And so here's the interesting part of all this. We have Americans all across the country who are saving for retirement hand over fist in what we call tax-deferred retirement accounts, like 401ks and IRAs. So what are they effectively doing? They're basically saying, I want to get a deduction, and I want to get that deduction at today's historically low tax rates, only to push the payment of that tax at far into the future, at a point when most experts agree tax rates are likely to be dramatically higher than they are today. And so $42 trillion are locked up in these types of tax-deferred accounts. And so essentially what America has done and is continuing to do at a record pace is go into a business partnership with the IRS. And every year the IRS gets to vote on what percentage of their profits we get to keep, which is not a great business partnership to be in. So for example, you could have $1 million in your IRA, but unless you can accurately predict what tax rates are going to be in the year you take that money out, you don't really know how much money you have. And that's a pretty tough position to be in when you're trying to plan for retirement. So really, back in 2013, 2014, I sort of saw the handwriting on the wall here. I saw what the fiscal trajectory of the nation was. And so I wrote a book called The Power of Zero. I threw it out on Amazon and sort of crossed my fingers. And to my eternal surprise, people started to buy the book. And it was later picked up by Penguin Random House and is sold around 400,000 copies. So I think it's a message that's really gaining traction. I think Americans aren't stupid. I think that they can see the handwriting on the wall as well. They can see that we are marching into a future where tax rates have to rise dramatically or we could go broke as a nation. And so really my mission has been to try to raise the warning cry to several generations of America who I believe are saving their retirement dollars in the wrong types of accounts. And if they've already saved those dollars in those types of tax deferred accounts, what can we do to reposition those dollars to tax-free so that by the time tax rates do inevitably rise, they've done all the heavy lifting and they can then take that money out 100% tax-free.
Right. So you referenced your flagship book, The Power of Zero, and how to transform your retirement to the 0% tax bracket. And that's ultimately a big part of our messaging and the curriculum that we teach now to folks that we're meeting for the first time or clients that we've been working with for years. So within that book, I mean, you have a lot of step-by-step strategies for how to go about this, because it's, there's methodology, right? And there's some subscribed methods for how to try to balance the different buckets relative to getting as tax efficient in retirement as possible. Maybe you could speak to that a little bit and how even the standard deduction plays a role in those subscribed balances and approaches mathematically.
Yeah, so the first thing I like to do is just try to convince people that taxes in the future are likely to be dramatically higher than they are today. It used to be a tougher sort of a chore to do that, but I think that lately, given all of the talk about debt, given Doge, given Elon Musk, going into the Oval Office with a chainsaw, I mean, it's on everybody's mind. Everybody is thinking about how the government simply spends too much. Elon Musk has been weighing in on social media day after day after day, saying that we're marching into this unsustainable future. And the creator of Dilbert, Scott Adams, who actually is apparently dying of cancer, has recently weighed in on his podcast, where he basically said, who cares if Trump is going to waive taxes on tips? He goes, at the rate we're going, there aren't going to be even any restaurants, right? I mean, I'm not quite that apocalyptic, but the point is this: a lot of people are starting to stand up and take notice that we are on a fiscally, a fiscal path that just doesn't add up. And every year that goes by where we fail to sort of right our fiscal ship of state means that the fix on the back end is going to be even more serious, more aggressive, more draconian. And so, So really convincing people that tax rates in the future are likely to be dramatically higher than they are today is really the first step. And then the second step is saying, okay, in a rising tax rate environment, there is actually a mathematically ideal amount of money to have in your IRA or 401k. And I tell people this all the time: you want to have your balance in retirement low enough that your standard deduction is equal to or less than your RMD is low enough. The balance in your IRA or 401k, or the cumulative balances in those accounts, are low enough that your RMD is equal to or less than your standard deduction, but also low enough that it doesn't cause Social Security taxation. Because Social Security taxation, a lot of Americans are going to be caught off guard when they find out that their Social Security can be taxed. And all that has to happen is for you to receive RMDs really from your 401k or IRA in the right amounts for it to have your Social Security get taxed. And so what we want to do is we want to keep the balances in those tax deferred buckets low enough that you don't have taxation. You can have your required minimum distributions offset by your standard deduction and have your Social Security also tax free. And once people recognize that there's an ideal balance in that tax deferred bucket, then the next question becomes, okay, how do we shift money, any surplus balance out of that bucket into the tax-free bucket so that we can be shielded from the impact of higher taxes down the road? Of course, the name of the game there is you want to do that shift slowly enough that you don't rise into a tax bracket that gives you heartburn, but you do it quickly enough that you get all the heavy lifting done before tax rates go up for good. And some quick and easy math here: if you're married, filing jointly, that ideal balance is going to be in the $400,000 range. And if you're single, it's about half that amount. And so really, how are we going to get this money shifted over? One of the biggest workhorses, and I'm sure we're going to get into different types of tax-free investments, but the biggest workhorse is going to be that Roth conversion. We want to stretch that tax obligation out over as many years as possible. And as we'll discuss when we discuss the big, beautiful bill, I believe that Trump is about to extend the Trump tax cuts, which if you count this year, that's going to give you 9 years during which to take advantage of historically low tax rates. And so I think there's a huge opportunity before America, particularly if these Trump tax cuts get extended, to really take advantage of a period of historically low tax rates to get our financial houses in order so that by the time tax rates do rise, sometime down the road, we've done all the heavy lifting and can take all that money out 100% tax-free.
Excellent. Yeah. So with this last big election we did have, politics aside, just looking at policy, I mean, I was hopeful that there would be the opportunity for the current tax codes to get extended, because it really does buy people more time to do this type of planning and get the word out there. And it's really amazing to me how few people really understand these concepts, as simply as having the ability to invest or contribute to a Roth through a 401k plan through your employer. I read an article the other day where 82% of major corporations offer the Roth option within their plan. But it still amazes me at how few people know that that's an option, that they can contribute a whole lot more than if it was the self-directed approach where they're not phased out for being high income earners. And that could be a real needle mover. What I will say is I don't believe that even in your methodology that it's a one size fits all. I think you would agree that many people are going to feel a greater level of conviction about how aggressive they want to be with confronting some of the inevitable as it relates to taxes in these deferred buckets. And so I think that there's an approach for everybody. If some, want to do this more mildly and still get more tax advantage, they're still going to have the benefit of having tax diversification when they're in retirement and not always have to draw on the bucket that they have to gross up when they need a certain amount of money. But then I also have plenty of clients that, because they do see the writing on the wall, they want to overhaul their whole portfolio and get it all into the tax-free places. So, maybe you could just share with the general audience here how one can benefit from each end of the spectrum.
Well, first of all, we want people to take advantage of every nook and cranny in the IRS tax code. Okay, we're not pushing one particular narrowly defined portion of the IRS tax code. We feel like there's between 4 and 6 different streams of tax-free income that may apply to any given person and their personal situation. So, and the reason why we can recommend as many as 6 different streams of tax-free income is because every single stream of tax-free income that's available within the IRS tax code has something that makes it unique. I'll give you an example. The Roth IRA is great. And what makes it unique, you can put in the $7,000 per year prior to age 50, 8,000 years 50 plus. What makes it great is that whatever you put in, you can take out immediately, right? You get instant liquidity on whatever you take out. Of course, you can put it back within 60 days if you so choose, but you have liquidity. I'm not saying that people should make it their emergency fund by any stretch of the imagination, but they have liquidity on that Roth IRA. How about Roth 401ks that you mentioned, Ryan? Roth 401ks are great because it's the only tax-free stream of income where you can get free money. Your employer's giving you a match. You can't get that out of a Roth IRA. And it also has, some of those higher income, there's no income limitations and higher contribution limits. I love the Roth 401k, the Roth conversion, because there's no limit. I joke about this, but it's true. Mitt Romney has over $100 million in his IRA. Different discussion altogether in terms of how that money got there, but he's got $100 million in his IRA. He could convert it all to Roth all in 1 year if he wanted to. There's no limit on how much you can convert to a Roth IRA. So the Roth conversion is going to be a huge workhorse and helping get people to the 0% tax bracket. We've talked historically about something called the life insurance retirement plan, which is we see it as a very popular sort of a solution for people that are worried about long-term care, because it has a death benefit component. It allows you to get your death benefit in advance of your death for the purpose of paying for long-term care. And if you die peaceful in your sleep 30 years from now, never having to need long-term care, someone's still getting a death benefit, probably your kids or your grandkids. So there isn't that sensation of having paid for something you hope you never have to use. The Wall Street Journal talks about this type of hybrid approach where you sort of use life insurance as long-term care as the most popular way to handle the long-term care sort of dilemma when people hit retirement. And then we talked about the taking RMDs out of your IRA. I think that's the holy grail of financial planning, taking RMDs out of your IRA and have that be offset by your standard deduction. Of course, if you can keep your provisional income low enough, then your Social Security is also tax-free. So that's sort of the 6 streams of tax-free income that you can utilize in trying to shield yourself from the impact of higher taxes. So our job, Ryan, your job, is really to try to show the maximum benefit that people can get by taking advantage of every nook and cranny of the IRS tax code. So what we do and what you do is we do what we call before and after comparisons, where we show people the mathematical benefits of implementing these types of strategies. Now, do people always come back and say, yes, I want to do 100% of that? Not always, because these recommendations can be pretty aggressive. We're talking if you've got $1.5 million or $2 million in your IRA and you want to get down to that $400,000 ideal balance, you're going to have to do some major shifting. We're talking taking advantage up to the top of the 24% tax bracket that goes all the way up to $394,000 of taxable income. Not everybody wants to do that. So our job is to show the mathematical benefits associated with doing the full plan. And then ultimately they get to choose how much of that plan that they want to implement. And our job is just to show them the cost of not implementing it at all, or only implemented it maybe halfway. So really the math is the corroboration of every strategy that we recommend. So ultimately we leave it up to the client to decide how much of the recommendation that they want to do, but our job is to show the full benefit of the math associated with implementing all 6 of those streams of tax-free income.
Awesome. And I think, a lot of that comes back to empowering people through proper education. And that's one of the things that I like about your books so much. I mean, I literally keep dozens of your books in my office and we hand these out on a regular basis because they are really that beneficial in terms of a resource to utilize to better understand what we're talking about here. Now, we all know there's two certain things in life, and we're not getting around either one of them, right? And so with that, the reality is we're either going to pay taxes now, we're going to pay taxes later, or we're going to kick the taxes on to somebody else. And so, one of the things that you said that I want to make sure it didn't get by the audience here is that one of the, I think, better kept secrets in our industry is how to use life insurance in this manner based on tax code 7702 of the Internal Revenue Code. And you wrote a book about that. And that was called Look Before You LIRP. LIRP as in LIRP, which stands for Life Insurance Retirement Plan. And I've also heard of this referred to by somebody that we know in common as the super Roth, right? As far as another way to grow your money tax-free and get some other benefits that go along with it. So with that, though, when you're saving inside life insurance, I think the traditional way of thinking of life insurance is we want to put in the least to get the biggest amount of benefit, right? That by definition is term insurance and essentially is appropriate for catastrophic protection. But what we're talking about here is permanent cash value life insurance. And the idea here is if we're going to save and try to accumulate, we don't want to put in the least. We want to put in the most relative to the plan and to the budget, in which case we don't want to also pay on these typically forever either. The idea is to get the money in, give it time to bake and cook and accumulate, and then be able to take the money out later on in our own lifetimes. So I ask people this question a lot, which is, can you be the beneficiary on your own life insurance policy without dying? Right. And the answer to that is yes. So maybe we can, touch on that a little bit deeper here and why this is one of the better kept secrets in our industry.
Yeah, any sort of cash value life insurance is going to be a super fraud issue. And the reason is because you have all of these mainstream media personalities, the Dave Ramseys of the world. I mean, what does Dave Ramsey says? We'll talk about the book that I wrote about Dave Ramsey. But Dave Ramsey says, 100% of cash value life insurance sucks 100% of the time. Suze Orman says, if anybody ever tries to sell you cash value life insurance, you are to turn around and never run away and never work with that person again. A guy named Clark Howard, who used to have a nationally syndicated radio show, he says the only person ever tried to sell you a life insurance policy is a money grubbing, commission hungry life insurance salesman. So you have that on one side of the spectrum. On the other side of the spectrum, you have Ernst & Young, who recently came out with a study in which they said that if you, they basically tested a lot of different scenarios. One in which, people from various age demographics did 100% stock market investing. And then they said, okay, what if we start to incorporate fixed index annuities? What if we start to incorporate, for example, the life insurance retirement plan? And what they found was it's not about how much you accumulate. It's about how much you can take out and how much income you can take out in a sustainable way over the course of your life. And what they concluded was in every single age demographic, people that had 40% of their money in the stock market, 30% of their money in cash value life insurance, the LIRP, and 30% in fixed index annuities, which is a way to sort of grow your money safely and productively and get guaranteed lifetime income. Those were the people that had the highest levels of income, had the highest likelihood that their money would last through life expectancy, and actually passed the most money on to the next generation. So here we have two types of financial tools that have been historically demonized and vilified by Wall Street in some cases, by mainstream financial media personalities in other cases, that have been shown by an independent third party, Ernst & Young, one of the largest accounting firms in the world, to be the combination of financial tools that will provide you the most income and give you the greatest possible outcome in retirement. And so these are types of financial tools that we talk about, that we show the math benefits of, and that we make the case for to members of the general public, and that I've done through my books as well, because mathematically speaking, they put more money in your pocket at retirement than the stock market approach. And I'll just give you one quick example of how this works. According to the reason Ernst & Young is advocating for cash value life insurance is because it works as what we call a volatility shield in retirement. And now we've all heard of the 4% rule. The 4% rule says that if you have $1 million in your IRA at day one of retirement, the most you can take out of that IRA is 4% per year, adjusted every year thereafter for inflation. So 40,000 that first year, 41,200 that second year, so on and so forth for the rest of your life. Well, the problem with that is it's a pretty expensive way to sort of purge longevity risk from your retirement to make sure that your money lasts as long as you do. And what Ernst & Young discovered when they did their study is that if you can accumulate between 3 and 5 years worth of lifestyle expenses in your cash value life insurance by day one of retirement, and then in the year following a down year in the stock market, pay for your living expenses out of your cash value life insurance, what that does is it gives your stock market portfolio a chance to recover before you make further distributions. And that act alone can increase the sustainable withdrawal rate on your IRA or 401k from 4% to as high as 8%, with a 95% likelihood that your money will last through life expectancy. So here we go from, you got $1 million in your IRA and you can only take out $40,000 per year adjusted for inflation, to now you can take out $80,000 per year adjusted for inflation. So you can start to see why Ernst & Young is starting to make the mathematical case for putting 30% of your retirement savings into things like cash value life insurance, and then of course 30% into vehicles like annuities that can guarantee you get a stream of income that lasts as long as you do. So these are streams of tax-free income. We're availing ourselves of the full financial toolbox, and everybody has some bias that they bring to the table. The only thing that isn't biased is math, and that's why I love that Ernst & Young study so much, is because they're relying on math. They did thousands and thousands of Monte Carlo scenarios, testing every possible scenario, and time again, they came back with this 40% stock market, 30% cash value life insurance, 30% annuity gives you the highest possible outcome.
Yeah, so you touched on something I think is critically important there, which is, when you're working with a professional or an advisor, I think it's important to know who you're working with. And with that, what tools do they have in their toolbox? Because I know there's plenty of Main Street investment firms out there that will limit their advisors on what they can work with and offer their clients. And so if it's not something they're going to offer, then naturally they're probably not going to endorse it. And they may try to fit a square peg in a round hole. And that's why we see so many, cookie cutter type, investment plans that are passive management that essentially send people on a roller coaster. I think that with the tools that you're referring to, which are a big part of my practice, we have a lot of different strategies that we can bring to the table that ultimately will create an integrated plan where one piece is helping the next and helps with the longevity of the accounts and help sustain, preservation of resources and ultimately, the ability to grow your money tax-free. I'm definitely one that drinks the Kool-Aid, Dave, is at this point between my wife and I think we have 4 LIRPs in the mix. So we are eating our own cooking around here in the South. So
awesome. Love to hear that. Yeah, between me and my wife and my kids, everybody's got an LIRP. So I've got 7 kids. So that means we've got at least 9 LIRPs in our family. And I'm not quite old enough, as notwithstanding the salt and pepper in my beard, I'm not quite old enough to start incorporating annuities into my mix yet, because I'm still in growth mode and have a lot of money in the stock market, but I certainly have a lot of money going into my LIRP year after year.
Yeah. So without, bashing anybody out there in the industry or in this arena, you touched on some names there, and specifically a book that it made me think of that you launched in December. This was your most recent book, called The Guru Gap. And on the front cover, it says how America's financial gurus are leading you astray and how to get back on track. So you referenced Dave Ramsey there. And, Mr. Ramsey is right around the corner from our office. This is where his headquarters are. So interestingly enough, we have the Dave Ramsey talk a lot. I think he's appropriate for the right demographic, but I'm not partial to any one size fits all recommendations when everybody's circumstances are different. But when you talked specifically about, Mr. Ramsey, when he says, buy term and invest the difference. Well, if you actually understand anything about the type of life insurance we're talking about, by definition, it is decreasing term with increasing cash value. So it actually does what he's suggesting, built in the same product, in the same contract. where I think the problem that most have is they tune into the buy the term, but they don't follow through with investing the difference. And then they wake up one day and they have a term that's about to lapse and they don't have the cash accumulation that they should have by following that disciplined approach. Whereas inside the LIRP, it's sort of mechanically doing all of that in the same strategy.
Yeah, and I don't want to pick on Dave Ramsey, but I'm going to, just because
It's too
you know,
easy.
Dave Ramsey, I think, is a good guy at heart. You know, I think he's helped a lot of people. If you're making 50 but spending 60, he's precisely the guy that you should be listening to right about now. I mean, that's his superpower. That's his wheelhouse, getting people out of debt and on the road to financial freedom. I mean, I don't think there's anybody in the nation that does it better than he does. However, when you're talking about when you hit retirement, you got $1 million in your IRA and you're trying to figure out how to spend that down in the most, sustainable way, he's precisely the opposite of the person you should be talking to right about now. And I'll just give you a quick example. I start off my book, The Guru Gap, with the story where this guy calls into the Dave Ramsey show and he says, "Hey, hi Dave, I'm in retirement. I want to travel a little bit more. My current financial advisor says that I should never take out more than 4% of my portfolio per year, adjusted for inflation." Of course, this is the time-tested gold standard in sustainable withdrawal rates. It's been redeemed by lots of studies over the last 4 decades. And he says, I want to travel a little bit more in retirement. I'm wondering if I could take 5% out. And Dave Ramsey says, your advisor is a financial planning lemming. And I had to look up what a lemming is. Lemming is like a small rodent that travels in packs. And sometimes when the lead rodent goes over the cliff, the rest of the rodents follow him right over. So basically he's saying, look, your financial advisor is leading you over a cliff. He says, I can help more people in 10 minutes than financial advisors like yours can in an entire lifetime. So the subtext of what he's saying is that, look, the mainstream financial planning community is wrong. Don't listen to them. And if you have a big financial platform, the quality of your financial advice is by definition big, right? Or good, or quality, right? Which we know those two things don't always follow. So he says, not only can you take out 5%, he says you can take out 8%, you can take out 9%, you can take out 10%, and you're going to be in great shape. And the reason is because we know that the stock market returns, gives you linear returns of 12% per year. If you have $1 million, it's going to deposit $120,000 into your account January 1st every year. I mean, these are the types of things that he's telling people. Let's go back to this idea that you can take out 8% per year in a sustainable way. Well, there's a very famous, financial income expert by the name of Dr. Wade Pfau. He actually wrote the foreword for my book, The Guru Gap. And he's actually been studying this for his entire career. And what he basically did is he says, if you do what Dave Ramsey said, which is invest 100% in stocks, he doesn't believe in bonds, and you take 8% withdrawal rates, he says you will run out of money in advance of life expectancy 63% of the time. It's not even a coin flip. It's 2 out of 3 times you will run out of money before you run out of life. So that's a problem if you're Dave Ramsey and you're telling America that they can take out 8% withdrawal rates on their retirement savings. So like I said, great if you're trying to get out of debt, but if you're trying to spend down your retirement assets in the most sustainable way, he's precisely not the person you should be talking about. And so that was really the premise for my book, is that a lot of times, because people have big platforms, we take what they say at face value and we don't ever critique it or scrutinize it. But when you scratch just below the surface and you look at the math that undergirds what they're recommending, it all falls apart and it's not sustained by any sort of mathematical, rigor. And so that's why I take things like these Ernst & Young study much more seriously. I take the studies that have been done by Wade Pfau and his colleagues over the years, and by academia over the last 4 decades. I take them much more seriously than someone like Dave Ramsey or Susie Orman, who's simply trying to take an inherently very complicated issue and distill it down into a 10-second soundbite. For example, LIRPs, 100% of LIRPs suck 100% of the time. Or Ken Fisher, who says, I would rather go to hell than sell you an annuity, right? What that does is that there's little pithy sayings that sort of dismiss financial tools that have been redeemed by academia with math and actuarial science for the last 4 decades. And so The goal of that book was really to start a dialogue with America over, sustainable retirement planning solutions and how to wring the most efficiency out of your retirement dollars.
Yeah, I can't believe he would say take 8%, you're okay. Because what happens when you take that 8% in a year like 2022 or 2020 with COVID or 2008? You're taking that money out when the market's way down, and you're going to run out of money quickly if you're pulling money out when the market's already down, aren't you?
Oh yeah, you're in fact, if you had retired in the year 2000 and started to take the 8% withdrawal rate like Dave Ramsey would have recommended, you would actually have run out of money in about 8 years. And so this is money that's supposed to last you a full 30 years in retirement, only it lasts 8 years. I mean, it's like kicking your portfolio while it's down, and it goes into a death spiral from which it's very difficult to recover. And so this is the type of math and actuarial science we're trying to bring to bear when we're having this dialogue with America over how to, what types of financial tools can be used in concert one with another to help make your retirement savings last the longest. And almost uniformly, listening exclusively to Wall Street or exclusively to financial advisors is going to be, by definition, excluding certain financial tools that have been designed to help you weather financial storms, weather volatility in the market, and maximize the amount of income you can draw from your assets in retirement.
That's why you need to work with somebody like Ryan, an independent financial advisor, because you look at all the possibilities and all the tools. And as a fiduciary, you're going to do what's in your client's best interest. And you can't do that if you take tools off the table. You can't be a fiduciary if you're not looking at all the options, right?
Yeah, I totally agree. And one thing I really appreciate about Dave and his approach, because I'm an analytical and I'm a guy that likes to let the math speak, is it's not, opinion based. He's using mathematics and, real credible data to back up, the methodology here, which, I fully endorse. So as we conclude, Dave, one last thing for you. So if this big, beautiful bill goes through and they do extend the current tax codes into permanent law, does that mean we're in the clear and that, tax rates are going to be at the lowest that we've seen and will see forever? Or where do we have concern that the tax train may still be bearing down on us, even if this legislation goes through?
I think Elon Musk said it best. He says there's no such thing as a big, beautiful bill. You can have a small, beautiful bill, or you can have a big, ugly bill, but you can't have a big, beautiful bill, because a big, beautiful bill by definition includes lots of spending, lots of debt, and only exacerbating the country's financial position over the next 8 years. So we know that if Trump extends the tax cuts for another 8 years, I think that no matter what, that's going to happen. They may trim a lot of fat out of this bill. They may reduce spending. They may find ways to offset the debt that's going to be brought about by the extension of these tax cuts. I think no matter what happens, whether it goes through as a big, fat, beautiful bill or a skinny, beautiful bill, whatever happens, it's going to get pushed through. Why? Because that's the signature aspect of this bill. Even the Democrats ran on extending the Trump tax cuts, at least for people making less than $400,000, which is most of America. So I think that no matter what, President Trump wants to deliver on this promise of extending the Trump tax cuts. I think it's going to happen this year. We also know that it's going to happen through budget reconciliation, which means they don't have 2/3 of Congress to be able to pass this into law and make it permanent. They have a narrow margin, a simple majority in the House and Senate. And so what's going to happen is they are going to extend it through what's called budget reconciliation. And anytime it happens through budget reconciliation, that means it has an expiration date, which means that it will be extended for 8 years, which if you include 2025, it's really 9 years more of historically low tax rates. Initially, they thought that this would happen by Labor Day, Memorial Day. Then they thought it was going to happen by July 4th. And there's some senators in Congress who are not wild about this idea that this bill blows up the debt over the next 10 years or so. So there's been some haggling as far as that goes, but I'm confident this is going to get done by the end of the year, because both parties promised the extension of these Trump tax cuts, at least for people making less than $400,000, or in Trump's case, for everybody. So it's going to happen in my estimation. And what does that mean? That means that if you have the lion's share of your retirement savings sitting in tax-deferred vehicles like 401ks and IRAs, that means you're going to have 9 years during which to take advantage of historically low tax rates, which is great, because what that allows you to do is stretch that tax obligation out over a lot of different years. If the cuts were going to expire, January 1st, 2026, we'd be having a different conversation right now, because we'd say, hey, look, you got 1 year during which to take advantage of historically low tax rates. We're talking 9 years. So even if you have $1.5 million, $2 million in your IRAs, you now have the ability to go all the way up. I tell people, go all the way up to the top of the 24% tax bracket. That gets you to about $394,000 of taxable income. You can get a lot of heavy lifting done over 9 years when you can go to the top of the 24% tax bracket. And by the way, the 24% tax bracket is still lower than the future version of the 22% tax bracket, which is 25. So it's the 24 is a good deal of historic proportions. When 2034 rolls around and these tax cuts expire and then the new tax cuts explode, we're going to look back on the year 2025 and say, why didn't we take advantage of that 24% tax bracket while it's around? Because it is a good deal of historic proportions. And so that's the huge implication for people that are trying to wring the most efficiency out of the retirement savings, is we're likely to have 9 full years during which to take advantage of historically low tax rates to protect, our retirement savings from the tax freight train that's bearing down on America.
All right. Very exciting stuff.
That's amazing. And David, a lot of great information. I am going to interject with my personal question for you. My favorite thing that you've done is the Infinity Code. I'm a huge mystery, thriller, suspense guy, and you wrote a novel. So I know we've talked and focused on the financial stuff, but I really enjoyed your novel. I love a mystery, thriller, and suspense. You're a best-selling financial author, a respected financial mind. How did that come about, writing a novel?
Well, this is during COVID. I love writing novels, and my wife said, if you're going to spend all this time writing a novel, it at least has to do something has to have something to do with business and your work. And one of the things that I've long been fascinated with is this idea of modern monetary theory, this idea that you have
MMT.
MMT, or we also call that the magic money tree, which basically says that because the federal government has the ability to print infinite amounts of money, it can therefore finance any number of social programs, social safety nets, any sort of initiatives that the federal government wants to do. I mean, we're talking guaranteed $15 minimum wage, universal health care, universal basic income, all sorts of paternal leave for a year. I mean, paid vacation, all these different things that the federal government could sponsor. And I make the case, drawing upon, I sort of weave this into the story, but because a lot of people say we won't ever have to raise taxes because we can simply print our way out of the problem. And this is basically the position that these modern monetary theorists take. So I basically use a cool, Dan Brown type plot device to weave these principles into the story and talk about how the only real way to, right our fiscal ship of state is not by printing unlimited amounts of money, but by actually spending less than we actually bring in. And so that was a fun novel to write. It actually foreshadows a little bit my next book that I'm going to write, which is called The Secret Order of Millionaires, which is also sort of a financial parable in which I discuss the 7 principles of tax-free wealth creation. And I weave that into a cool M. Night Shyamalan type story that has a really cool twist ending. And I think that anytime you can couch financial principles within a really cool story, it's a lot better than a boring business book. You give people an excuse to not just pick up the book, but also to finish it to see what's going to happen at the end. And so this is a book that's aimed at the Gen Zs and the millennial generations who are a little bit behind the 8 ball when it comes to saving for retirement in comparison to their Gen X and baby boomer forebears. And so the same publisher who published The Guru Gap is also going to publish this book. And so I'm excited about the story and to throw it out there to see what America thinks.
Great. When's that one coming out? Do we have a release date yet?
Yeah, unfortunately, these publishers have really narrow bandwidth. They can only publish so many books in a year.
Yep.
So this is actually set to publish, I believe, April of 2026.
Oh, okay. So we got a little ways to wait, but I can't wait. I just had to ask you about that since I had the opportunity. I just know you've got a big fan. I love the fiction as well. So,
I appreciate that very much. Thank you.
yeah. Well, Ryan, great show today. What a huge get, Ryan. I'm impressed. I was already impressed with Ryan as a host of his own show. He does a great job with the financial knowledge, but getting David McKnight on the show is a good one.
Yes, Dave, and thanks again for joining us. We are honored and appreciate all you do and the mission that you're on, and happy to be one of your underlings with the POZ group.
Well, I've enjoyed the friendship, Ryan. Enjoyed coming to see you there in Tennessee when we had the chance a few years ago, and look forward to doing it again in the future. And really appreciate you guys having me on.
All right.
Thanks again.
Yeah, thank you to David McKnight, and thank you, Ryan. Listeners and viewers, thanks for tuning in. That does it for today's episode of More Financial Talk.